Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in company filings, and hint hint, this one involves selling shares and warrants, but with a twist that might make you raise an eyebrow. Today we're diving into VEEA Inc's latest filing, a Form 8K, which usually means something sudden and important happened. Think of it as a company's breaking news announcement to the SEC and all of us investors. And this report drops some interesting news about how VEEA is raising money. So what exactly is this filing about? VEEA Inc., a company you might know from its common stock trading under the symbol VEEA, has just announced they entered into a really important agreement on August 12, 2025. This agreement is called a Placement Agency Agreement. Now that sounds fancy, but basically it means they hired someone AGP Alliance Global Partners to help them sell their company's stock and warrants to investors. This whole deal is a registered public offering, which means VEEA is selling new stock to the public. They aim to sell a lot of shares, up to 9,239,096 shares of their common stock. Plus, they're throwing in a common warrant with each share. A warrant is like a ticket that gives you the right to buy a company's stock later at a set price. In this case, the exercise price, or the price you'd pay to buy the stock with the warrant, is $1.10 per share. These warrants will expire 5 years after they're issued. Let's quickly look at what VEEA has listed on the stock market. They have common stock with a tiny par value of $0.000000 in the Nasdaq. They also have warrants, the same ones we just talked about, which let you buy common stock trading under VEEA, also on the Nasdaq. Now, VEEA is flagging itself as an emerging growth company. This means they meet certain criteria, like having less than $1 billion in annual gross revenue, and it allows them to take advantage of some relaxed rules for public companies. This is pretty common for newer companies. Here's where it gets really interesting. A significant chunk of these shares, 3,239,096 to be exact, along with their accompanying warrants, were given to a company called VEEA Inc. This wasn't a typical cash sale. Instead, these securities were exchanged for the company clearing its own debt. Specifically, VEEA was extinguishing some of its outstanding non-convertible promissory notes, which, along with accrued interest, totaled 3,000 other layer to this transaction. The public offering price was set at $1 per share, and with each share you got a warrant. This is a pretty low price point for a public offering, which can signal different things. It could mean the company is trying to get a lot of investors in the door, or it could reflect the market's current valuation of the company. However, there's a crucial detail in those warrants. They have ownership limitations. A holder can't exercise their warrant if it would push their ownership, including their affiliates, above 4.99%, or if they choose 9.99%, 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 or if they choose 9.99% of VEEA's total outstanding common stock. This is a standard way to prevent any single investor from gaining too much control, especially in smaller offerings. The entire offering wrapped up on August 14, 2025. This was all made possible by a registration statement that VEEA filed with the SEC earlier in July and was declared effective by the Commission on August 12, 2025. Now let's talk about the deal makers, the placement agent. They earned their keep. VEEA agreed to pay them a cash fee of 7.0% of the money raised from investors they brought in, and 3.5% for investors VEEA itself brought in. But here's a key point. The placement agent received no cash fee for the securities purchased by NABs. This makes sense as that part of the deal was a debt for equity swap, not a cash transaction. VEEA is also covering the placement agent received no cash fee for the securities purchased by NABs. This makes sense as that part of the deal was a debt for equity swap, not a cash transaction. VEEA is also covering the placement agent received no cash fee for the securities purchased by NABs. This makes sense as that part of the deal was a debt for equity swap, not a cash transaction. VEEA is also covering the placement agent's legal fees up to $70,000 plus another one for the agent's legal fees up to $70,000 plus another $10,000 for other expenses. So how much money did VEEA actually bring in? They received about $6.0 million before all the fees and expenses were paid. After deducting the placement agent's fees and other estimated offering expenses, VEEA's net proceeds were around $5.3 million. The company plans to use this money for stocking up on inventory, building up customer support, general operations, and other corporate needs. VEEA has also agreed to a lockup for 90 days after the offering closed. They won't issue any more stock or announce any new stock issuances, with a few exceptions. This is to stabilize the stock price and prevent dilution right after the offering. Even VEEA's own officers, directors, and major shareholders who are connected to them have agreed to hold onto their own shares for 90 days. This lockup period is a pretty standard practice to give the market time to digest the new shares. Like most deals, the agreements have the usual clauses. They include standard conditions for closing the deal, promises from VEEA about the accuracy of their information, and ways for either side to back out if things go wrong. VEEA also has to promise to protect the placement agent from certain future issues and stick to certain ongoing promises. Beyond the main agreement, VEEA also put out a press release on August 13th about the pricing of this offering and another one on August 14th about the closing. These press releases are included as part of this filing. Now, this is an important disclaimer that you see in almost all SEC filings. They mention forward-looking statements. These are basically their best guesses about the future. Using words like expect, intend, anticipate, and believe, they're saying that a lot of what they're saying is based on future expectations and predictions, not guaranteed facts. They also list out a bunch of risks. This is standard boilerplate, but it's worth paying attention to. They're talking about challenges like growing the business profitably, keeping important relationships, retaining their key people, and dealing with market volatility and changing regulations. They specifically mentioned that their projected financial information might not turn out to be accurate. This is a reminder that while they're aiming for success, there are many things that could go wrong. They are very clear here, don't take their future predictions as gospel. They also mentioned that they don't promise to update these statements if things change, so it's up to us to keep an eye on what's really happening. Finally, the filing lists all the documents that support this report. We have different forms of warrants, the agreements themselves, and those press releases we talked about. And the report is signed by Alan Salmasi, the Chief Executive Officer of VEEA Inc. SID. Now, let's put on our analyst hats. VEEA successfully raised about $5.3 million in net proceeds from this offering. That's a decent amount for a company of its size, especially with the share price at just $1. The strategic move to pay off debt with stock, especially for an affiliate, is a common tactic, but often raises questions about transparency and potential conflicts of interest. The low exercise price on the warrants and the ownership limitations are standard, but can influence how the stock behaves in the future. The 90-day lockup periods are also typical. What's the story here? VEEA is actively seeking capital to fund its operations and growth, which is a positive sign of ambition. However, the reliance on a public offering at such a low price point, along with a debt for equity swap involving an insider, might suggest that traditional financing avenues were either unavailable or less attractive. This could indicate either current financial pressures or a strategic decision to move quickly to secure funds. The key risks for VEEA, as they themselves point out, will be their ability to manage growth profitably and navigate a competitive landscape. The $5.3 million raised will be crucial for their stated goals of inventory and customer support infrastructure. But it's not an unlimited war chest. Investors will be watching closely to see if this capital injection translates into tangible growth and improved financial health, or if it's just a temporary fix. We need to see if they can really manage their growth and maintain key relationships without their financial situation becoming precarious again. The market's reaction to the new shares and warrants will also be telling. In conclusion, VEEA's latest move is about securing necessary funds for growth, using a mix of public offering and debt settlement. While the strategy is clear, the execution, particularly involving related parties and a low entry stock price, warrants careful observation. The company's future success will hinge on its ability to execute its business plan effectively with the new capital and overcome the inherent risks they've outlined. What's your take on VEEA's fundraising strategy? Do you think this offering will set them up for success, or are there red flags you're seeing? Let me know your thoughts in the comments below. If you found this deep dive helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more breakdowns of SEC filings. And don't forget to join our Discord community linked in the description for more real-time discussions on these matters. Thanks for watching, and we'll see you in the next one.